In this video, we'll break down the protection you have relative to your bank accounts, credit union accounts, and your investment accounts. If you don't know who I am, my name's Chris Dime. I'm a certified financial planner out of Edmonds, Washington, and I specialize in working with folks to and through retirement. With the recent failures of Silicon Valley Bank and Signature Bank in New York, a number of clients have been asking about what protection they have relative to their bank, credit union, and investment accounts. Obviously, this is pretty popular in the news, so today I thought we'd cover FDIC, NCUA, and SIPC. And if you don't know what those acronyms are, that's totally fine. That's what we're here for today. So first up, FDIC, or Federal Deposit Insurance Company. This is essentially a government-run insurance policy that protects banking customers from the failure of the bank to repay them the deposits that the bank took and went and further invested on their own. All participant banks pay insurance premiums to the FDIC. That's essentially the fund that would go towards refunding clients who lost all their money as the result of a bank failure. We'll have to talk another time on why banks fail in the first place. Obviously, during challenging economic cycles like the Great Depression in 2008, it's going to be very hard for banks to remain solvent when, during the economic challenge, whatever they're invested to would be susceptible to that investment risk. So for example, in 2008, if a bank is heavily invested in housing-related investment products and the housing market collapses, it's going to be very difficult for a bank like Washington Mutual to maintain solvency. And even if the bank was going to maintain solvency just fine, rumors and other concerns that would lead customers to quickly withdraw all of their deposits would cause what's called a run on the bank, where the bank would need to quickly sell out of investments at obviously an inopportune time to create enough cash to repay all those customers their banking deposits. Obviously, like any investment portfolio, if you have to sell out of an investment portfolio at an inopportune time to come up quickly with cash, you're probably going to take a loss. And in fact, the economy doesn't even have to be struggling in the first place. It's even possible during periods of economic boom that a bank could still struggle with solvency if, for example, they lack sufficient diversification on their balance sheet, or if their customer base is tied to a particular industry and that particular industry has some challenges. And of course, there doesn't have to be anything wrong with the bank at all. If there's a massive run on the bank and the bank was not prepared to refund all these deposits, then I imagine that bank is going to struggle with solvency as well. Rest assured, in times like this where the bank is struggling with solvency, the government is here to save you. And they save you by way of what's called FDIC. FDIC insurance protects your deposits in a banking institution up to $250,000. What that means is if your account is worth $250,000 or less and the bank you have fails, you are entitled to receive back that $250,000 or whatever amount was less than that. However, that also means if you have deposits in excess of $250,000, the excess of $250,000 might be totally lost. Now, there are some ways around these rules, such as using multiple different banks and different bank accounts and titling your bank accounts differently so that $250,000 of insurance is applied to multiple accounts that might all tie back to you somehow. We'll save those strategies for another video to dive into. But at the end of the day, the takeaway is deposits over $250,000 might be totally lost. And while on a personal side, having over $250,000 might not be that common for a banking institution, definitely for businesses that might have over $250,000, this can be a real challenge. Generally, when a bank is on its approach to failing, the FDIC, as well as some other regulators, will assist that bank in getting acquired by a much larger, much more solvent bank. In 2008, we saw this with Bear Stearns, as well as Merrill Lynch when that had to get bought out by Bank of America. However, if a bank can't find a purchaser fast enough, then FDIC would be actioned on, and we'd have to go through that whole rigmarole of FDIC taking over the bank and then refunding deposits back to consumers up to $250,000. The other thing to keep in mind is that not all banks are FDIC insured. There are a number of banks that are what are called non-member banks, and these are banks that have chosen not to opt into the FDIC program. This means that your deposits have no insurance. The way to verify if your bank is FDIC insured or not is to just look at the disclosures on their website and it'll say member FDIC. So we've talked about how banks can provide FDIC insurance so that you can rest assured that if your account's worth less than that, you don't have to do a run on the bank to get your money. Of course, if you need the money faster than FDIC processes would dictate, then maybe you go get your money. But when it comes to protection, theoretically, you have up to $250,000 of protection. But what if you're one of the many people that don't actually use a bank and instead use a credit union? The good news is it's almost the exact same process. The naming is just a little bit different. So rather than Federal Deposit Insurance Company, you have what's called National Credit Union Administration, or NCUA. It functions nearly the exact same way as FDIC, where you have up to $250,000 of insurance coverage in your credit union account. Similar to non-member FDIC banks, there are also non-member NCUA banks. And so I'll include a list down below in the description of a roster where you can go to see if your credit union is NCUA insured or not. So you might be thinking, hey, that's all well and good, but I don't keep over $250,000 in cash at any time. Most of my assets are invested. So what's your protection there? There actually still is some protection here, and that would fall under the SIPC, or Securities Investor Protection Corporation. Side note, what I go on to describe here only pertains to that brokerage firm's solvency. It does not apply to you losing money from security selection. So for example, whatever your investment account is invested into, that is not backed up by SIPC. And if you lose money because you made a bad bet or the markets are gyrating, then you lose money as a result of that. You are not entitled to action on SIPC insurance to get any sort of money recuperated from market losses. All investments are subject to risk. So as it pertains to the brokerage firm, however, think of this as the company that actually is responsible for your login. This is the company you see on your statements, and this is essentially the company that's tracking what you're invested into. These would be companies like Fidelity, Vanguard, Schwab, LPL, etc. In the event that these brokerage firms fail, your accounts are actually insured up to $500,000 at a minimum for member brokerage firms. And while your account is insured up to $500,000, the cash specifically is only insured up to $250,000. So theoretically, if you had a $500,000 account that was entirely invested in just cash, you'd only have $250,000 of coverage. Whereas if you had an account that had 20 grand of cash and then 480 grand was invested in capital market securities, then your account would be insured up to $500,000. And there's no pop quiz on this, but to keep it simple, that just means all cash pretty much between banks, credit unions, and investment accounts are insured up to $250,000. One thing that's important to know relative to the security of your investment accounts as well is, unlike banks and credit unions, investment brokerage firms are not allowed to take your deposits and then go and invest those into other investment securities. Any investments you make actually have to be held within a separate entity at that brokerage firm. So if ever you hear the term depository trust company, what that refers to is the company in charge of your investment securities. And that's a separate bucket of money than the brokerage firm's assets. So while it might all seem like just one big bucket when you open up your investment account, you see the name of your brokerage firm and then your securities, know that in the background, those are actually two separate pools to further protect you. So all brokerage firms do need to separate the two. They're not allowed to commingle those pools of money. In addition, all brokerage firms do have to be SIPC members. However, that doesn't mean that every company that offers to take your money and then pay you back more in the future would be considered an SIPC registered institution. And I'll link below in the description a list of SIPC member brokerage firms. So you can rest assured if you log into your company, you can verify if they're on that list. The last thing I would add on SIPC coverage is, yes, while the minimum clients have up to 500 grand per customer in insurance through SIPC if the brokerage firm fails, most of the larger institutions have private insurance on top of that. So for example, LPL Financial, which is my primary investment custodian for clients, that not only has the SIPC coverage, but it also has a $750 million aggregate insurance policy on top of that. So now that we know the limits on how much protection you have with your bank, credit union, or brokerage firm account, it'd probably be in your best interest to look at those limits in comparison to what you have deposited at each one of these institutions. If you have over $250,000 with a bank or credit union, it's probably going to be in your best interest to look at opening up a different account with maybe a different institution or titled differently. And the FDIC website has a breakdown of what titled differently means. That way you have $250,000 of coverage on different accounts that are ideally below those limits. And with your brokerage account, while you are insured up to 500 grand, if you have more than 500 grand invested with any particular brokerage company, I don't necessarily know if it's in your best interest to open up different accounts from there. You would want to look into if that brokerage company has an additional private policy on top of the basic SIPC. That way you don't have to worry about opening up multiple accounts with multiple institutions and managing all that. Instead, you can rest assured that whatever institution has your money has the adequate protection that, in my opinion, they should have if they're going to routinely hold accounts over 500 grand. So that does it for today. Hopefully it was helpful. If you have questions, drop them in the chat below, send me an email, we'll get you squared away. Have an awesome rest of your week. We'll chat with you later. Bye.